Hello traders, so welcome to the 7th chapter. So in this chapter we're going to be looking at entry patterns. So we have already looked at various things that are going to help us now formulate two entry patterns that we are going to be using in our trading. So in this chapter we're going to be looking at two entry patterns that we'll use in the majority of our entries. And one pattern will be very crucial because that is the one that will be used mostly compared to the second one, and we'll see more details about it in this lesson. So just as a recap, we have already outlined and looked at time and why it is important. Under time we have looked at daily, maybe the day of the week and time of day. We have also looked at price range. We have looked at fair value, and under fair value gap we have looked at under fair value we have looked at order blocks, liquidity and fair value gaps. We have looked at market structure, order flow, bank sponsorship, weekly and daily buyers. So by now you have already known how to define your weekly and daily buyers. And now we're going to be looking at entry patterns. So entry patterns, essentially the purpose of this lesson is to show you once these fair value reference points have been hit, and you have seen in the market that you have maybe bank sponsorship coming in. How do you frame your setup from that level that has been hit now to the opposing, even before it hits it, so that you can have a range of opportunity for you to capitalize and maybe make some profits. So let's go deeper into this lesson, and then we'll look at maybe the patterns we are talking about here. So watch till the end to learn more in detail what the kind of patterns I'm talking about in this lesson. So the first thing you want to notice, there are only two patterns that we're going to be discussing in this course. I'm naming them entry pattern 1 and entry pattern 2. So there are only two ways that the market turns. So these patterns, actually they will indicate the only two ways that the market turns after it hits a higher time frame, either order block, a liquidity, takes out some form of liquidity, or hits a fair value gap of the higher time frame. And remember, when I talk about higher time frame here, I'm referring to the weekly chart, the daily chart, and I'm introducing the 4-hour chart as the bare minimum in terms of entry, where to look for entry patterns to form. So in the next lesson, actually we'll be focusing on where setups form, and you'll see that I've introduced the 4-hour chart. But for now, let's focus on the pattern and how it looks like. So actually this pattern is what you want to be backtesting and ensuring that you grasp the idea. So actually entry pattern 1, as I will outline here, is the one that you need to focus on. But if it doesn't form, you'll see that entry pattern 2 is just a backup in case you don't see it form, as I will outline in the entry pattern 1. So this is the lesson actually you want to really backtest. This is the lesson I can't teach enough. You have to go back to your charts and backtest for you to see it for yourself. So it has to be imprinted in your mind, these two entry patterns, and you have to know exactly how it forms. So there are various ways it will manifest itself, but you have to look at example after example for you to really come to terms with how it looks like and how it forms in price action. So looking at the first pattern, actually you'll notice that I'll outline the bearish and the bullish scenarios in each pattern. So this is the first pattern, and this is the one I'm saying that it forms majority of the time. The reason I like this pattern, even myself in my trading, is because once, for example, we are bearish, so this is the bearish scenario, and this is a key level. So a key level here, it could mean either a daily order block, a daily fair value gap, a weekly order block or fair value gap, or some liquidity has been taken in the daily or weekly chart. And then when it was coming to hit that level, it falls short of that level initially, then starts to fall away as if it is moving away from that level or rejecting it, even though it has not hit it. And then it falls short, creates a low, then aggressively it comes and takes out this high, hitting the key level. So you'll see I've outlined here buy side liquidity is taken. So this high being run, that is essentially what I'm referring to as buy side liquidity being run. But you might have even some other form of liquidity in previous session that could have been taken by this run, but you want to see this high being run also. So this is the difference between the two patterns. You'll see in the second pattern you'll not have this scenario, but when you focus on this pattern, you'll see that this high will be run, and then immediately you want to see immediate response. So this indicates an immediate reversal away from that level once it hits that key level, and then it takes out this short-term low. So this low here, I've indicated this as the market structure shift. So it comes and takes out this low, and then it leaves an imbalance in this range. So this imbalance being left here is your entry point. Once the market now comes back to revisit that area that it broke structure plus that area that it leaves an imbalance. So that is your actually sweet spot for seeking an entry. And this pattern, actually, in terms of time, you want to focus on the Monday, Tuesday, Wednesday, and I've also included Thursday, but sometimes Thursday may not manifest. And then you also want to focus on the London session and the New York session. So essentially, this is a breaking structure. This is a fair value gap being left here. You want to place a stop loss above the high that took out this high. So the high that are trailing liquidity, that's where you want to place your stop. Your entry in this range inside the fair value gap around the area that it broke structure. That is your entry right there. So reverse for bullish, you want to see sell side liquidity being run, and then it falls short initially of that key level, then starts running higher, leaves that short-term high, then comes back down to hit that level, taking out this sell side liquidity and any other previous session liquidity, maybe in the left side of the chart. Then immediately you want to see reversal, leaving an imbalance, taking out this high, creating a market structure shift, and then immediately it comes back after creating this range, comes back to retest that area that it broke structure coupled with that imbalance. So that is your confluence right there. So immediately you want to place your stop there and your entry there, and then you target any daily highs or any highs or buy side liquidity when you're bullish and sell side liquidity when you're bearish. So that is it about this pattern. That is all you want to be looking for, and you want to look for this pattern at a key level. So it's not just anywhere. You want to look it at a key level and be very mindful of the time and session that we have already discussed. So as an example, I've outlined here, this is a key level. So this is the daily chart of EURUSD. We have hit an order block right here in this. So our focus is here. We have hit a daily bullish order block, meaning we are bullish on the bias on the daily chart was bullish and the weekly was bullish. So we have hit a bullish order block, and the market now responded. So let's see how it behaved in the lower time frame right there. So that's the same area that we already outlined. So we had that key level as the daily bullish order block, and then we had this sell side liquidity from, this is Tuesday, this is Thursday, and this is Friday. So actually this is an example where Friday we saw a reaction, but as I've outlined, Friday is not the best day, but this is because we had high impact news, NFP. So we hit that order block on the daily chart. So you can see actually this low, this is where it falls short, then it comes back, takes out that low, and then immediately this is the response you are watching for. So actually this is what I teach as bank sponsorship. Immediately it is obvious, takes out that high, a short-term high, creating a market structure shift, then leaves that imbalance. So this is an area that is very a sweet spot for your entry, and it's at New York session kill zone. It's at 30 a.m. New York time. So you want to target the nearest liquidities, which is this highs up here. So essentially you want to see order flow shifting immediately towards and run aggressively towards those targets. So when you take your entry there, you want to see that aggressive run. So actually this first pattern is the highest probability of the two patterns, and it is what you should be seeking to find when you enter the markets with a clear bias, either the weekly or daily bias. So once the bias is clear and we hit those reference points like the order block, fair value gap, or some form of liquidity being taken out in the higher time frame, this is a very high probability entry pattern. So let's say for some reason you have not seen that entry pattern number 1, then there is high probability that we'll be seeing this pattern. So these are the only two patterns that you'll be seeing when the market is turning at a key level. So in this instance, it's just almost the same, but now we have the key level, but the market, instead of falling short initially and then coming to take out buy side, what it does, it comes directly and hits that key level, then starts going lower, then makes an attempt to maybe come and take out this high, but fails. So this is actually the signature of this setup is that it fails to run this high. Then immediately you see a shift in market structure, leaving an imbalance just the same way the other one leaves. And then at that point where it shifted plus the imbalance, you want to take your entry, then sell if you're bearish into the nearest liquidity. So we want to also be looking for this scenario either Monday, Tuesday, Wednesday, or Thursday during London or New York session. So the only reason you're coming to this pattern, as I've outlined, is if you have not seen the first pattern. So you might probably see this if the first pattern does not manifest, and then this move actually should have taken liquidity on the left side of the chart. So liquidity is constant, it has to be taken out before you consider that this is high probability. So even in this example, you might find some sell side liquidity being run on the left side of the chart, but now this low is not taken out. That's why you are placing a stop right there and a stop right there. So immediately it attempts to come back down to take out the low, but it fails, then aggressively runs higher, breaking market structure. So once it breaks that market structure, that is your signature now that the market wants to run for opposing liquidity and opposing targets. So you wait for the market to come back down into an imbalance of fair value gap coupled with that breaking market structure point. So sometimes it might hang above maybe a fair value gap right here, so not necessarily perfectly touching that breaking market structure point, but you want to at least see it retrace back before you consider an entry. So as I've outlined, in case the market does not form the first entry pattern, it will form this pattern that I've just outlined, and then it will usually be at a higher time frame order block, liquidity, or fair value gap. Now as an example, this is the daily chart of the Euro USD. So we actually saw the market come high and take out this previous day's high. So this is what I've indicated as the daily high. This is actually liquidity being run. So this is liquidity in the daily chart. So when you drop into the lower time frames, you'll actually see that same area. So this is a high of the daily being taken out. So this is a daily liquidity. It was run, so you can see immediately it just came aggressively and took out those highs, then started to drop, but then created that low, made an attempt to take out these highs but failed. So that is the key signature of this pattern. This is at 8 a.m. New York session. Then aggressively it breaks lower, market structure shift, leaves an imbalance. So you'll see the market come back up, retest that area. So this is where you want to be entering, and then immediately you want to see this immediate response to run for this liquidity. So this will be your targets. So even with this run, this is enough to close the day, but we see it coming to take out that low during the next day London. So that's the signature of these patterns. So as I've outlined, you want to focus on the first one, but in case you don't find the first one, then the second one will manifest. This is the only way the market turns. You can check any pair, any time frame, doesn't matter. this is the only two ways that the market will turn. So you can go back to your charts and start backtesting. Go and study, because you cannot just take my word for it. Go and study, see it for yourselves. You want to see it by experience and also by your own charts, doing your own studies. So I'll urge you to go and backtest and journal what we have been taught in this lesson, because this will be very crucial in the next few lessons, where I will be teaching where setups form, because this is the patterns you'll be looking for when you outline where setups will be forming. And also the trading plan will include now everything brought together. So after we have known where setups form, we'll now go deeper into a few more details, and then we'll finally finish with developing our trading plan. So you'll know how to develop your trading plan so that you can know exactly what you need to do in order to formulate setups, find opportunities, and execute. So as an exercise, just go back to your charts, backtest, journal, and you want to find these two entry patterns, where they form and how they turn the buckets. You want to condition your mind actually to see these patterns by journaling numerous examples. So this is the part where you have to now go back and just do the work. This is the part where you actually take 6 months to just backtest and journal, backtest and journal, backtest and journal. That is what you'll be doing. So once we complete the trading plan development, of course now from the trading plan you will start your backtesting. But now this is where you can start. As we continue, you can just catch up and continue from there. So thank you so much for watching. I'll see you in the next video. The next video will be talking about where setups form. Thank you.